Okay, so today I am going to be covering a lot of practice questions for the life insurance pre-licensing exam. Now, this is specifically for the exam in Florida, but if people are watching this video and they're watching from another state, it's okay. Like 90% of it, or a lot of it's going to be similar. Obviously, if you see laws pertaining to Florida, then it wouldn't be. So which of these is a method of determining the level of funds required for ongoing support in the event of the breadwinner's death? So human life value is a method for figuring out how much money would be needed. Most of the answers are bolded here. So human life value is how you figure out how much money would be needed for a spouse if the breadwinner dies, okay? It's kind of crazy. Life insurance companies assign a value to our lives, but I mean, at the end of the day, we do have a life value of what we provide and contribute, okay? So you do have a price tag. All right. Everybody get that? Any questions about that, human life value? Okay. Which of the following factors affect the amount of monthly disability benefits payable under Social Security? And if you don't learn about disability on it, it's all right. This is stuff that won't hurt knowing this. The state where the recipient lives, the number of children dependent on them, the cause of the disability, and the amount of benefits available from other sources.
Is it the cause of disability?
I'm pretty sure this one isn't highlighted. It's the amount of benefits available for other sources. Chad, you would know that. What factor affects disability benefits under Social Security is the amount available from other sources? How much made in the past too? Okay, that's not one of the options on here. It's just one of the options is the amount. It says the cause, the number of kids dependent on the recipient, the state you live, or the amount of benefits available from other sources. Would probably be the other sources. Yeah, makes sense. Yeah, because Social Security is federal. So Pat owns a 20-pay life policy with paid up dividend option. Which of the following statements is true? The policy may be paid up early by using accumulated cash values, right? So paid up dividend means that the policy can be paid up early. Anybody know what a paid up whole life means?
No.
Paid up whole life means it's been paid. Like you don't have to make premiums on it anymore. So if you have dividends that keep contributing to your premium, it may get to a point where it's paid up. So dividends are.
They can only pay it up with dividends. Like you can't. Okay.
No, you can pay it up with cash, right?
Okay.
But it can pay up faster with that. All right. Typically, it's when a policy is first. If you get a whole life policy, you can't just all of a sudden make a huge payment on it because it changes the stuff in the policy itself. But if you have like a policy that does pay up at some point and it's set for that, then because it's a 20-pay life policy, right? It'll just pay up faster with the dividends being in there. So you can pay it up either with your premiums over 20 years, but if your dividends may end up paying it up faster. I don't know if that makes sense.
Yeah, that makes sense.
Anybody have any questions on that? All right. How many months can a life insurance policy be backdated?
I'm sorry, I was my book. I'm looking for my book.
You're fine. I'm going to mute you here. How much? So a life insurance policy can typically be backdated 6 months. Okay. So backdated 6 months from meaning like I can date the policy as what, September 23rd, essentially. This is as far as I can go back, usually. I've actually never seen that, but I guess that's what the state wants you to know. All right. What is the Florida definition of life insurance replacement? This is like every state's definition. It's not where coverage is increased. It's not where group life coverage is converted. It's not where a policy owner reinstates a lap policy. It's where a transaction in a new policy is bought and an old one is canceled. That's a replacement, okay? That's replacement. Replacement is not if you go from term to a whole life and convert it. That's not a replacement. Replacement is if like you have one whole life and you cancel it and get another whole life. That would be replacement. Or a whole life, you cancel it and get a term, okay? or like a term and you cancel it and get a whole life rather than converting it. Because you can convert term policies, which is temporary insurance, into permanent insurance. Because it costs more money for the same death benefit, and the company's cool with you paying more money for the same death benefit. Any questions about that? Okay,
No, sir.
awesome. Which of the following can an agent provide to help a prospective client understand and purchase the most appropriate product? Policy summary, buyer's guide, illustration, condition, or receipt. The buyer's guide, the state's like super crazy about everyone knowing about a buyer's guide, even though no one actually cares about it when they sell insurance. All right. Which of the following areas of state regulation is not protected by the savings clause in ERISA? It's commerce. I guess that's just something to know.
I have a quick question real quick.
Yep.
So I remember somewhere throughout the course in the YouTube video, it mentioned that before the person agrees on to the premiums, I think it was, that there was some sort of, I don't know if it is the buyer's guide, but there was something that we had to read to them before
Disclosure.
okay.
It's so if they pay, then they need a conditional receipt. I would go through that. I'm not exactly sure what you're referring to.
It shows up on the test, the state test, and it shows up on the learning thing that you were talking about. There's a disclosure thing that
Is it
that comes
the
up.
Medical Information Bureau disclosure, or is it the
It sounds like when you brought up the conditional receipts, like something you have to read to them. That's what it sounds like to me. I don't know.
Yeah, it's I know what you mean. It's something with like a consumer. I have it right here.
I don't think it's a consumer report. It's just something that you gotta like let them know.
Fair Credit Reporting Act notice.
Okay.
I think maybe. So you do have to get them a buyer's guide either before they, like, upon delivery of their policy or before that. I would look into that. That'll be in the application, the notes on the application part on the study guide here. Oh, buyer's guide provides generic. Oh, this is exactly here. A policy summary is included when the policy is delivered. Buyer's guide provides generic information. Policy contains an illustration. Coverage starts when the initial premium is collected. Upon deliverance, delivering the policy is required. There's a delivery receipt. Let's see here, insurable interest. There's a producer's report. They must sign it. It's got to probably be in there somewhere.
I'll read back. It's fine.
Cool. Every resident agent must have and maintain at their place of business the usual customary records pertaining to transactions under their license for at least how long? So 5 years of records, okay? 5 years of records for your business. A life insurance rider that allows an individual to purchase insurance as they grow older, regardless of insurability, is the guaranteed insurability rider, okay? Cost of living rider will increase the death benefit based on the like inflation, okay? Because they say, hey, if you have $1 million policy now, the $1 million won't be $1 million in 20 years, so it'll increase that. Accelerated benefit rider is where if someone's terminally ill, then they can get the money advanced to them ahead of time, or if they have a medical condition where they can get some of the death benefit ahead of time. Guaranteed term rider is a right. Again, I don't know exactly what that is. I know a term rider is if someone adds term to their policy, to a whole life policy, they can cover someone else under term, or they can add additional term to themselves with a whole life. So it's like a bonus. It's like I have $100,000 whole life with a $100,000 term rider. Maybe guaranteed term rider means they can add another term rider later or something.
Yeah, without showing in proof of insurability.
Perfect. Yeah. So that's it. So guaranteed term rider is someone can get a term policy later, or a term rider added to their whole life policy without having to prove that they're insurable. Any questions about those? Okay. An insurance company can contest a life insurance contract due to an application fraud within 2 years. So within 2 years, most insurance companies will contest a death claim, which means that if someone passes away in the first 2 years of the policy, then the insurance company says, hey, you shouldn't have died that soon or else we wouldn't have insured you. We're going to contest this claim and see if you lied about anything. And if it comes up on the application that they did lie about something, then they won't pay the claim. Okay, they'll rescind the policy and pay back the premiums.
So what if, sorry, my question's about that, because there was a question on the test about it. What if the person is like now 10 years in the claim into the policy and they do die? Would they still get the full death benefit or no?
Yeah, so after 2 years, right? Death of any reason pays out fast. There's no
Okay.
contestability after 2 years. So you can lie, and if you live more than 2 years, then you're good.
Thank
Okay.
you.
Yep, no problem. Which of the following is not a consequence for placing business with an unauthorized insurer? Third-degree felony, responsible for unpaid claims, insurance license revoked, first-degree misdemeanor. I don't know why they care so much about that. It's like you'll never even have a chance to sell an unauthorized insurance company, but which is not a consequence for placing business with an unauthorized insurer. So it's a third-degree felony. You have to pay any unpaid claims. So say like you sold someone an unauthorized insurer policy with an unauthorized insurer, and it was $1 million policy, and they die and the family files the claim, you're on the hook for that $1 million. Okay, and it's a third-degree felony, and you lose your insurance license. You have no chance of that ever happening to you because there's no way you could sell an unauthorized insurer with how everything is set up. An individual most likely will have an insurable interest in insuring a person's life if a financial interest exists at the time of the insured's death, a business relationship exists, an economic interest exists for the continuance of the insured's life, there's any blood relationship with the insured. So insurable interest means I have an economic interest in you living. Right? Does that make sense? If anybody here is married, then there's probably an economic interest in the other person being alive. Okay? Or maybe you're the economic interest. I don't know. But one way or another, that's the case. Okay? Jay is an agent. You should say that to your partner. Be like, you're just an economic interest to me. You know that?
You want to be fighting.
Hi, economic interests. Hi, good morning. All right, Jay is an agent who recently told a claimant that his rights might be impaired if he does not complete a release form within a specific time. What could this agent be found guilty of?
Coercion.
Yep, exactly. So twisting. Anybody remember what twisting is?
I still get the two twisting and coercion, and the other one. I always get those three confused. I finally figured out what rebating was when we discussed it. I think on a Zoom call a couple days ago. But twisting, coercion, and the other one, because I think they're like similar.
Yeah, so we'll look it up. I think I know what it is.
Twisting the when you try to make
Churning. That's what it was. Twisting and churning. I couldn't figure the word out.
It's similar. Okay, LeGrand, what were you saying?
No, I thought the twisting was when you're trying to make one seem a little bit more appealing just for the financial incentive.
That's exactly what it is. Yeah, it's when you try to make one seem better than another,
But they don't
with
really.
exactly, with misrepresentations or incomplete comparisons.
Mm-hmm.
So it would be like saying like, hey, I have someone has a whole life policy, and then you're trying to sell them a term policy, and you're like, yeah, but this one's way cheaper. And it's like, okay, yeah, but like, I'm only gonna have it for a year and then it's gone. Whereas my whole life,
it's not benefiting them.
Yeah, it's essentially lying about. So twisting, I'm twisting the truth about a policy.
That's a good way to remember that.
That's it. You got to find these little things to help you out, right? Yep. Coercion is just bullying someone into getting a policy. It's like threatening them with something. So it's like saying, hey, you're gonna have your right revoked.
What would be the difference? What would be the difference between churning and coercion if like this
I mean,
example
churning and
here.
twisting.
No, churning and coercion. Like the example here you said is coercion. It's kind of the same thing.
No, coercion is like if you're threatening someone to do something with physical or mental force, right?
So
Mental
it's churning.
force, I don't know. Churning is if there's one policy and then you have someone cancel it and then you rewrite it with another company or that same company just to receive new commissions.
Oh, okay.
Mhm.
So it's like completely.
So imagine you got a client, you're just churning the client in butter to make, yeah, I saw that, Garrett. You're just churning the business. You're moving it around to other companies to get new commissions. Okay.
All right.
It's like, because you get paid an advance commission and the first year commission in life insurance is always bigger than the rest, right? So if there wasn't a rule against that, people would just sell a policy, have their clients cancel, buy one the next year, have their clients cancel, buy one the next year. So they just keep getting first year commissions. So that's definitely not okay.
I wouldn't think so.
Nope. All right. So under a life insurance policy, what does the insuring clause state? The agent obligation to pay a death benefit, the insurer's obligation to return all premiums upon approved death claims, the insurer's obligation to pay a death benefit upon an approved death claim, or the agent's obligation to provide proper amount of coverage. So I think that's pretty obvious, I think, right? It's one of the more obvious ones.
Yes.
Which settlement option pays a stated amount to an annuitant, but no residual to a beneficiary?
Life income.
Yeah, it's just life income. I think life income with period certain is the one that will pay to a beneficiary. Is that right, guys?
Yes.
Life income with period certain. All right. The Department of Financial Services serves as the receiver of any insurer placed into indebtedness. Yeah, it's receivership. So the financial term for insolvency of an insurance company is receivership. Okay. Make sense? All right. They like making new words for the same shit. I don't know why they do it, but they like to do it. They're like, we're just gonna make new words for everything and then quiz you guys on it to torture you.
I haven't noticed that.
Yep. Which of the following is a reinstatement condition? Changes in the insuring clause, premium decrease, premium increase, proof of insurability. It's insurability. So to reinstate a policy is if a policy lapses, okay? So imagine Miss Betty is 72 years old. She's paying her premium every month. She passes. No, she doesn't pass. Sorry, that's a claim. And then she misses 3 payments. She's lapsed. A month or two goes by. She gets diagnosed with something crazy. She's like, oh, wait, that's right. I have my policy. I'm so sorry, guys. I forgot to pay. I'm just going to pick back up where I left off and pay you the back premiums. They're going to say, well, you can do that, but you have to show us that you are still okay, Miss Betty. So they have to prove that they're still insurable. Does that make sense?
Yeah. Don't you need proof of insurability for a replacement policy as well?
I mean, yeah, because you are getting a new policy. So when you do a replacement, you're getting a new policy. So you have to have evidence of insurability every time you get a new policy.
Because I know renewable, because when I was looking at renewable and convertible policies, I think it was the replacement policy that you needed proof of insurability for.
Yeah, so renewable, you don't. If it's guaranteed renewability, then
Yeah.
you don't have to show evidence of insurability.
Well, yeah, because it's renewable.
Conversion, you don't either. You don't have to show evidence of insurability for converting.
Okay. I'm glad I was right on that.
Yeah, the only time you really do is, I think if someone converted like a whole life to a term policy, then they would, because they're lowering the amount of money. Anytime you lower the premium or increase the death benefit at the same premium. So if you're lowering the premium for the same death benefit or increasing the death benefit for the same premium, you have to show evidence of insurability. Okay. A beneficiary has just received a claim payment. Tina, do these kind of sound like the ones on the exam a little bit?
Yes.
Okay. So you guys want to learn this one? I'm going to have my assistants pull me up another one. We have insider trading going on here for these test questions. So I am risking absolutely nothing in doing this, but I'm going to pretend I am risking like something to get you guys these. All right. A beneficiary has just received a claim payment for a life insurance policy. Hopefully it wasn't anybody important. Which of the following is true regarding the federal income tax liability owed? How much income tax is paid on life insurance policies?
0.
0. The IRS absolutely hates it too. But they, it actually, the argument of insurance companies, which essentially run the world, is that the taxes would actually cost the government. So it would actually cost the government more money to not pay the tax or to not get the tax than it would if they got the tax. Because if someone, say, leaves their family $1 million policy and then they have to pay income tax on that, they're really only getting like $500,000. So they say, well, people are going to need more government assistance, and they're going to end up actually costing people more money. So that's why they do it. Dorian exercised a non-forfeiture option by using his life policy's cash value to purchase an extended term insurance option. When the term insurance expires, he has the option of resuming the original policy, paying the same premium. The protection ends. Okay. Okay. So an extended term policy is when you say, hey, I'm going to use all my cash value to buy a term policy. And then once that term policy is done, you don't have coverage anymore. That makes sense? Cool. Nonprofit insurance providers that are covered by a special section in the Florida Insurance Code are called fraternal insurance organizations. Okay. Or fraternal benefit societies, either. The fraternals. Okay. It's like the, I don't know. It's like an insurance company, but it's not. They say they don't make any money, but they have a ton of money. It's, you know, like those nonprofits that say they're broke, but like all the executives are super rich. It's kind of like that. All these are a prerequisite for becoming a licensed agent, except you do not need a high school diploma to do this. Okay. Actually, the richest life insurance agent in the world dropped out of high school. Gideon Duplessis, he lives in South Africa. He makes like 70 million a year, I think, and he never went to high school. He never finished high school. So, yeah. In this business, you can just outwork people. That's how you win. You just outwork people. What's up, April? I see you there.
Hi, Justin. Do you need it? Can you, do you have to have a GED or you don't need anything?
Nothing. You don't need anything.
Oh, wow.
You don't need a GID. You don't need a diploma. You don't need a degree or anything like that. Yeah.
Thank you, Justin.
Yep. 18, complete a pre-license course and be a resident of Florida. Actually, one of our top agents, I don't think ever finished high school or got a GED. An underwriter's primary responsibility to an insurer is to protect against natural selection. No, yeah. I can see how maybe people get confused on that though. Imagine they had insurance policy to weed out maybe, I don't know, adverse selection. All right, is the one. Risk selection, inverse selection. So it's adverse selection, adverse selection, okay?
Mhm.
Adverse selection is the rule, is the law, or essentially the idea that only people who who would need to use the insurance would actually buy it, okay? So that's why it's much easier for us to market and sell final expense policies to people over 60, because typically if someone over 60 has a higher chance of having some sort of a medical condition, and also it's just at a different point in their life, right? It's easier to market insurance to someone who is older, maybe less healthy, than someone who's younger and really healthy. Okay, so that's adverse selection, where the only people who would really want insurance, life to pay for life insurance, like anybody here who's really healthy probably wouldn't be like jumping out of the seat of their pants to buy a life insurance policy. They probably wouldn't be like super pumped about going to buy life insurance. But if someone got really sick, they'd be like, geez, I'm pretty motivated to buy life insurance right now. So adverse selection is the idea that only people who need to use the insurance will buy it. Any questions about that?
Mm-mm.
All right. Where would policy proceeds be paid if both the insured and primary beneficiary were killed in the same accident?
So on the test, it's called something else. It says simultaneously something.
Yeah, if they die simultaneously.
Yeah.
Yeah.
Justin, would you have to list a contingent beneficiary in order for that to?
No, you don't. If there's no contingent, I think it just goes to the estate.
Okay.
Yeah. You don't have to list a contingent. I mean, it's like super rare though, like, you know.
I have a question pertaining to the last question or the last thing that we spoke about before this question, as far as elderly people or people that are sick being more likely to get or seek out an insurance policy. How often do, say, younger people or people that don't have sickness get insurance? I know it's probably not relevant, but
No, yeah, that's a good question. With us, not really, because we market typically to people who are over 50. That's our
Okay.
primary target market. So most of the people we're going to sell to are older, and a lot of them happen to have some sort of chronic illness or condition. There's plenty that we sell to who are healthy, but like, I mean, if someone's getting older, it's easier to market them a burial final expense plan, because it's like, yeah, it's just a natural financial, it's just financial planning, basic financial planning, right? Make sure when I died, no one's left the bill. Okay.
Okay.
So, but there are plenty of insurance companies that sell policies to younger people, right? Like we have the company I started with, New York Life, like they want young, healthy people with money buying insurance. So they'll sell like, large face amount. They prefer to sell large face amount whole life policies to people who make a lot of money. And it's a great, those cash accumulation policies are big. And also, if someone has kids, they should get a life insurance policy, because then like they have to replace their income to someone for 20 years. So that's an easy sell. A small term policy to someone who's got kids, it's like, it's like a no brainer. It's like, yeah, cool. I'll pay 100, 50 to $100 a month to make sure that if I die, my kids are taken care of. So.
Okay. So it's more just like different companies that target a certain demographic or age group kind of
Yeah,
thing.
every company's got their own thing that they want to specialize in. Yep.
Okay. Thank you.
You're welcome. And some life insurance companies sell annuities. They don't even want to sell life insurance. So they all do their own thing. Yeah. Okay. If an agent would like to sell variable annuities, which state examination must the agent pass? Variable, obviously, annuity, right? Yeah. This is a Florida only one, by the way. How many days does his insurance company have to reject a reinstatement application before it's automatically reinstated? I guess it's 45. So it's good to know. 45 days to reject an application to reinstate a policy. If they don't, that's in Florida. If they don't reinstate, if they don't give proof, then it's automatically going to be reinstated anyway. Okay.
Yeah.
An insured individual and the policy's beneficiary die from the same accident. The common disaster provision states the insurer will continue as if the insurance will, I don't know what it's an insurer, but it'll continue, it continues as if the insured outlived the beneficiary. So insured in the policy beneficiary die from the same accident. Oh, okay. So what it's saying is that if the insured and the beneficiary,
That's where's the premium?
your common disaster insurance.
Disability income.
We'll just clear this up here because I think my assistant like spelled it, put something wrong in there. Common disaster. When people die at the same time or under circumstances we can't tell who died first, it's called a common disaster simultaneous death.
I think that's right.
So in common disaster, just know the insured outlived the beneficiary. Okay. Which would mean that it gets paid to the contingent, right? That's where they're saying that. So if they don't know who died first, but it's the same accident, they're going to assume the money goes to the contingent beneficiary, not the family of the primary. Does that make sense?
Okay.
So it's like plane crash. Okay, well, they didn't die at the exact same time, but they both died. We're going to assume that the beneficiary died first. So then the contingent beneficiary is up and the benefit goes to contingent. Y'all follow me there? All right, thanks for the focus, everybody. In Florida, when agents recommend changes be made for existing coverage, the agent must follow established procedures. So in Florida, they call it the Florida replacement rule, replacing policies. Pretty, yeah. Q is severely injured in an automobile accident and becomes totally disabled. How many months must Q be disabled before being able to apply for Social Security disability benefits? I guess it's 5 months. All right. Okay. Which situation accurately describes a reduced paid up non-forfeiture option?
Policy.
Face amount of the new policy is same as the original policy. The policy has a decreased face amount. So reduced paid amount, reduced paid up, non-forfeiture option. So your cash, so the cash value has to do with non-forfeiture option. So essentially you're converting your cash value to a paid up insurance policy. And it's like, hey, you haven't paid up your life insurance policy yet, but based on how much you paid into it, you're gonna have this much of insurance that you don't have to keep making payments on. So it's usually a much smaller amount. Does that make sense to you guys? It's like, hey, I'm just gonna stop early. Instead of taking the cash value, you can say, hey, you know what? I'm not gonna keep the cash value. I just wanna have a policy that I don't have to keep making payments on. They're gonna lower the death benefit to whatever that cash value would purchase at the time. That's pretty much how it's figured out. There are probably some other factors involved, but. Yeah, this study guide will be available. I mean, this is posted in this test is available in the group chat and the pin messages. So you guys can go into GroupMe and click on the pin messages and you can get it from there. How many days must a rollover be completed in order to avoid being taxed as current income? So 60 days. So you have to roll over something within 60 days for it to be taxed in order. So what happens is like if you you can't take the money from your 401k and keep it for more than 60 days before it's taxed. All right. So if you have it for less than 60 and then you immediately put it into something else, then it's not a taxable event. All right. So when you have a qualified plan that hasn't had taxes paid on it, if you change it, you have to do it within 60 days, or else if you just have the cash, they're going to tax it. In Florida, an insurer licensed to conduct business in Florida but domiciled in New Jersey is called a
Foreign company.
foreign company. That's right. So if they are domiciled in another state, they're foreign. If they're domiciled in another country,
Alien.
then it's alien. Alien. Yep. Which of these is not considered a life insurance forfeiture, non-forfeiture option? Reduced paid up insurance, extended term insurance, cash surrender, it's life income annuity. So reduced paid up insurance is just what we talked about, right? It's like, hey, I've had $100,000 whole life for 25 years. I'm gonna have reduced paid up. Maybe you'll have like a $30,000 plan or something like that you don't have to keep making payments on. An extended term insurance policy is gonna say, hey, you don't have to keep making payments. You'll have X amount of insurance for however many years and then it goes away. Cash surrender, it says, just give me my money. It's my money and I want it now. And then they deposit in your account.
Oh my
And
God,
then I know. And then life income annuity. Okay. In order to activate the reinstatement clause of a lapsed life insurance policy, the insured must provide evidence of insurability.
yes.
The premium for a modified whole life policy is
Lower than the typical whole life policy.
yeah, for the first few years and then higher for the remainder. Okay. Which of these is not a legal entity for selling life insurance in Florida? An independent agency system, risk management advisors, career agency system, personal producing general agency. I didn't know, I don't remember this, but risk management advisors. Okay. Peter has a policy where 80% to 90%, and this is the thing, guys. So I've been through several different courses. All the courses have like most of the information, But the thing is the state does not always reveal everything that they're going to have their questions on. So the tough thing is it's like a guessing game sometimes. It's like the MCAS, well, that was from Massachusetts, but like maybe the FCAT is what they call it in Florida or whatever. It's like, or like someone takes like the LSAT for law. It's like they're not going to tell you exactly what you need to know for it. It's like, hey, you got to have a pretty good idea of this stuff, and if you know if you know the material, then you'd be good. Like Tina, she was so close to passing. You're going to pass it next time for sure. So Peter has a policy where 80 to 90% of the premium is invested in traditional fixed income securities, and the remainder of the premium is invested in contracts tied up in a stipulated stock index. What kind of policy is this? It's an equity index full life. It's important to know where the premiums are invested to. Okay. All right. And you guys remember, this will be available in the group chat for you guys to go through this to practice on as well. Okay.
This whole thing that we're going over right now.
Yeah, it's been there. I put it in there and everything. So it's in the pinned messages in the group chat. This practice exam. I'll put another one in there too. I'm going to try to find another one. Under a non-qualified annuity, interest is taxed after exclusion ratio has been calculated. I don't even remember what that is. But something to know. So interest is taxed in an annuity, in a non-qualified annuity. Okay.
It's all messed up.
Ron has a life insurance policy with a face value of $100,000 and a cost of living rider. If the consumer pricing index has gone up 4%, how may Ron increase the face value of the policy? $4,000, right? So this allows you to increase your policy. Now you're gonna have to pay more, but you can increase the face amount based on inflation, essentially. Which of the following is a requirement for any change in an insurance application? They have to initial the changes, right? Okay. Barbara's policy includes a rider which allows her to purchase additional insurance at specific dates. Without evidence of insurability, this is a guaranteed insurability rider, okay? All right, so I'm gonna leave off there and answer any questions that you guys have. You guys can keep going through those questions in the group chat. I put the link, so it's the jbe.com. Do I need an email to log into GroupMe? You just download the app called GroupMe, and then you click on the link on the website, jbe.com/student/. So www. I'm going to put it in here again. The jbe.com/student. Okay. Right. So if you click on the pinned messages in the group chat, then that's where this will be. Anybody have any questions?
Justin, real quick, I guess after, if I could stay behind a little bit, I just have some questions regarding the courses, not exactly about the questions that you just went over, because I haven't started the courses yet. So do you mind waiting?
You can ask. No, I mean, you can go. I have to be somewhere at 5. So
okay.
It's not at 5,
So
you can
just
ask
real quick, I don't start until Monday, because this whole week I have like prior